Good afternoon, everyone. Uh, on behalf of CI, we thank you for attending this webinar. Uh, if my voice is audible, I would request if someone could type in the question box yes. Okay, thank you very much. So we'll start this webinar. See, this is a 1 hour webinar in which we will have 45 minutes of presentation. The last 15 minutes we will keep for question and answers. There's a question box on your screen in which you can type your questions. Then I'll reply to those questions as in the order in which I receive. However, in this webinar, it's a one-way webinar in which I cannot hear your sound. So the only way you can communicate is through typing your questions. So this webinar is on GHG emission inventory and carbon neutrality. In this webinar, we will be covering how to prepare GHG emission inventory and the carbon neutrality. There are two standards for GHG emission inventory. The standard is ISO 14064, and for carbon neutrality, the standard is PAS 2060. We would be covering details of both the standards. Initially, first few slides, I will inform about the background. Then we will go over some of the definitions. Then we will go over key requirements of ISO 14064. We will also look at some of the commonly used methodologies for preparing GHG emission inventories. Then we will switch on to carbon neutrality. We will look at some of the requirements of PAS 2060. We will also discuss the various scenarios for becoming carbon neutral. And in the end, we will see the benefits for an organization for becoming carbon neutral. Also, we will briefly touch upon two new topics. One is carbon pricing and other is recommendations of the task force for climate change related financial disclosures. These are some of the two recent developments. So I thought it will be good to inform about these new developments. What are the different types of carbon pricing? What are the task force recommendations? Because as you know, the climate change is a very burning topic. Uh, so we will start with the Paris Agreement. See, as most of you would be aware that in COP21, the parties adopted the Paris Agreement. India had deposited its instrument of ratification on 2nd October in 2016. Actually, 2nd October being the birthday of Mahatma Gandhi. In 2016, India ratified the Paris Agreement. In 2015, on 2nd October, India submitted the INDCs. So, for any agreement to come into force, they need minimum 55% of ratifications. So last year, the UNFCCC, they received the uh, threshold and the Paris Agreement has now come into force as of 4th November 2016. There are three main articles in Paris Agreement which are of importance. One is Article 6. Article 6 talks about the use of market-based mechanisms, how various countries can exchange uh, the voluntary offsets to meet their INDCs. As you are aware that CDO market is down, there are a lot of people have carbon credits, but there are no buyers. So under the Paris Agreement, a new kind of mechanism will develop. However, the shape it will take is still not clear. The Paris rule book, which will give further details of this new mechanism, will be ready by November 2018. So by November 2018, it will become more clear as to what this new carbon mechanism would be. So the parties, they submitted their INDCs. The INDCs are intended national determined contributions. These are the commitments that have been made by various countries to reduce GHGs. This slide shows a comparison of India and China INDCs. India has committed that by 2030 they will reduce their emission intensity of GDP by 33 to 35%, whereas China has committed 60 to 65% reduction of their emissions per unit of GDP. India has set up a very ambitious target of renewables. Around 40% of the electric power installed capacity will be from non-fossil fuel based energy resources by 2030. China also has committed that the share of non-fossil fuels in primary energy consumption would be around 20%. Also, there are targets set for afforestation. One very important aspect is that China has committed that by 2030, they will be achieving the peaking of the CO2 emissions. However, India has not committed to any peaking of emissions. Peaking of emission means that by 2030, China emissions will increase in absolute numbers. However, per unit of GDP, they will come down. And after 2030, when they achieve peaking of emissions, then their emissions in absolute terms will start coming down. So in other words, India is committing reduction of emission intensity per unit of GDP. But in absolute numbers, India's emission will increase. And China emissions will also increase in absolute numbers. However, after 2030, their emissions will start coming down. If you look at USA and EU INDCs, although point to be noted here is that as per the recent announcement, US may withdraw from the Paris Agreement. They have kept a window open for negotiations, but that's a very big development that has taken place. In the INDCs, USA had committed 26 to 28% reduction by 2025. And whereas if you see the European Union, they had committed 40% reduction in their GHG emissions compared to 1990 levels. So the important aspect here is that India, China and US, we have taken a baseline of 2005, whereas European Union, they have taken a baseline of 1990. In other words, European Union emissions will, their reduction will be much more because they are reducing with respect to 1990 levels. See, now we will look at some of the definitions. Uh, First is the carbon footprint. See, carbon footprint is a term that is used to describe the total amount of GHG emissions that are caused by an activity or an entity or an organization. The sum total of all GHG emissions is declared as carbon footprint. Whether it is CO2, whether it is other gases like methane. So all other gases are converted into CO2 equivalent by multiplying by the global warming potential. Also, there is another term which is product carbon footprint. See, when we call a product carbon footprint, then we are looking at the entire GHG emissions emitted by that product to the entire life cycle. So there is another standard for that, that's PAS 2050. So when we talk about GHG emission inventory, we talk about GHG emission inventory for an organization. So we have a refinery or we have a steel plant or a cement plant. The total amount of GHG emissions emitted from the cement plant would be its carbon footprint. We will look into further details of inventory in the subsequent slides. Now we'll see the definition of carbon neutrality. What do we mean by carbon neutral? Carbon neutrality is a condition in which there is no net increase in the emissions. See, it is not possible for any organization to reduce its GHG emission to zero. Definitely, there will be some process. They will be consuming some fossil fuels. There will be DG sets, which will be emitting GHGs. Organizations can do energy efficiency, do fuel change, and take several other steps to reduce GHG emissions. but they cannot bring down the GHG emissions to zero. So whatever the balanced GHG emission that remain, for that they purchase offsets so that there is no net increase in GHG emissions. So in the subsequent slide, we'll go into further details of carbon neutrality. Now we will start our discussions on GHG emission inventory. The relevant standard for GHG emission inventory is ISO 14064. ISO 14064 has three parts. The first part is uh, at the organization level. In other words, in the first part, they describe about how to calculate GHG emissions of an organization. So ISO 14064 part 1, it talks about calculating GHG emissions of an organization. ISO 14064 part 2 is at the project level. Project level means a company puts up an energy efficiency project. Now how much GHG emissions they have reduced because of that energy efficiency project. So guidance for that is given in ISO 14064 part 2. ISO 14064 part 3 is regarding validation and verification. There are validation and verification bodies, these are third party bodies who will come and verify your GHG emissions. Now these bodies also need to have some criteria based on which they will come and validate and verify. So that criteria is specified in ISO 14064 part 3. And these validation verification bodies also need to have some accreditation. They need to have competent people, they need to have several other requirements which are given in the accreditation document. So only those bodies which have the accreditation can come and verify your GHG emissions. So the requirements for accreditation is given in ISO 14065. So this is a diagrammatic representation which shows the difference between the two standards. On the left side, if you see the ISO 14064 part 1, it talks about designing and developing organization level GHG inventory. That means if you have a refinery or a sugar industry or a cement plant, how to calculate your GHG emissions for your industry. So the outcome of this ISO 14064 part 1 is that we have a GHG inventory report, we have a GHG emission reduction calculation sheet, and these in GHG terminology is called GHG assertion. We are making an assertion that this is the organization GHG emission inventory. So these inventories are verified. So as per ISO 14064 part 3, if you see at the bottom. And then on the right side, you will see ISO 14064 part 2. So this part 2 gives requirements for designing and implementing GHG emission reduction projects. That is, if a company puts up a solar plant, a rooftop solar, by which they reduce GHG emissions. So how to calculate emission reductions happening because of the solar plant. So those requirements are given in ISO 14064 part 2. The output of this standard is we have a GHG project documentation and reports, which you again call it GHG assertion. So if you see on the left side, we have only verification mentioned. On the right side, we have validation and verification mentioned. Because when you develop a project, you need to first of all validate the project. That is, whether you have used the correct methodology, your equations are correct. Only when it is validated, then you can go for verification of emission reductions. So there's a slight difference between 14064 part 1 and part 2. In the part 1, the emission inventories are verified. In the part 2, projects are first validated and then verified. And how this is done? This is done as per the requirements given in ISO 14064 part 3. And also there is another standard ISO 14066 that gives competency requirements for the validation and verification teams, because the officials or the personnel who come to validate and verify your inventories, they also need to be competent. For example, a person is going to a refinery to validate the GHG emissions, he should be aware of the refinery process. He should be aware of the various units in a refinery, such as crude distillation unit, vacuum distillation unit. Only once he knows the process details, then he'll be in a position to actually verify whether the GHG emissions are correctly calculated or not. So the requirements for competency are given in ISO 14066. Now, the first step in calculating an inventory is to set up the organizational boundaries. Organizational boundaries in broad sense, it refers to the physical boundary or the number of companies for which you want to calculate an inventory. The standard gives two approaches for setting up organization boundary. These two approaches are control approach and equity approach. In the control approach, organization can either select financial control or operational control. So, uh, what do we mean by financial control? A company is said to have financial control if it has the ability to direct the financial and operating policies of an organization. In other words, company can direct the financial operations of the organization. Suppose there's a corporate office and then there are several units under the corporate office. So corporate office can direct the financial or operations of the units. So it will have full financial control over it. And the second is in terms of operational. That is, a company is said to have operational control if it or one of its subsidiaries has the full authority to introduce and implement its operational policies. So by control we mean the company should have either financial control or an operational control. So if nowadays most of the MNCs they are into diversified businesses. See, there are companies who are into real estate, then there are other subsidiaries into uh, hospitality sector, in the software, then in the automobile. So many companies you will see nowadays they have diversified their operations. So when they calculate inventories at the corporate level, now they have to either select those units for which they will report inventory, for which either they have financial control or operational control. So in the subsequent slide, I'll show some examples, then probably it'll become more clear. The second approach is equity approach. Equity approach means that a company will account for those GHG emissions uh, in the proportion of the equity that they have in the subsidiary or another company. In other words, a company A has 20% equity in company B, 30% equity in company C. So 20% of the B's GHG emissions, 30% of the C's GHG emission, they will account in their own GHG emissions. So the two approaches are either control approach or equity approach. Control can be either financial control or operational control. In equity, the GHG emissions which are proportional to the equity share in that company, those are considered. So a parent company or a company may not be having any financial or operational control, but they still may be having some equity in another company. So if they select the equity approach, then if they have 30% equity, so 30% of the GHG emissions, they will have to report in their own GHG emissions. So in the subsequent slide, I'll show some examples, then it will become more clear. See, for example, British Petroleum. See, British Petroleum, they are reporting their GHG emissions based on the equity share. And why they are using the equity approach is that they want to align their GHG emissions in line with their financial practices. So when they are preparing their balance sheet, so they are taking the profits from different, you know, companies all over the world in which they have the equity share. So in the same way, they take the GHG emissions in the proportion of the equity in which they have invested into their own GHG emissions. So that their financial reporting as well as GHG reporting, those are in line. So this is one example which shows that why a particular company is reporting on equity share basis. For example, British Petroleum may be having some equity in a company in Indonesia, but they may not be controlling either financially or operationally. But may still be having 30% equity in a company. So 30% of those GHG emissions they will report in their overall GHG emissions. And why they are doing this is because 30% of profit they are taking from that company. So 30% of GHG emissions also they are taking from that company. So their financial reporting and their GHG reporting are in line. If you look at Shell, Shell is not using equity, but Shell is using the operational control. And why they are using operational control is because they have health, safety, and environmental performance monitoring guidelines. So in all the companies in which are under Shell, so those companies follow their HSC guidelines and they also report on the HSC parameters. So all those companies where Shell has operational control, so they will take those GHG emissions as the Shell GHG emissions. So what happens is that their HSC reporting and GHG reporting are in line. So we have seen two different examples. In the earlier example, the British Petroleum has aligned their financial reporting as and the GHG reporting based on equity approach, whereas Shell they have aligned the HSC reporting and GHG reporting, together, so that their GHG reporting is in line with the HSC reporting. So different companies can have different criteria. And this is a very good example that I had observed. See, British Petroleum was having some equity in company. Uh, I think in the Reliance KG basin, British Petroleum was having an equity around 30%. So British Petroleum is using the equity approach. So 30% of the KG basin GHG emissions British Petroleum is reporting. But the Reliance KG basin, they are using the control approach. So they are reporting 100% of the GHG emission based on the control approach. So for the same organization, two different companies, they are reporting differently. So it all depends upon the organization policies as to which approach they would like to take. Whether they would like to take equity approach or they would like to take operational control approach, and what is the basis for that. So organization will declare that why I am choosing equity. Either I want to align with my financial reporting, or why I am using control approach if I want to align with my HSC reporting. So once the organization boundary is set, that means in the first step, we have selected which all organizations we would be reporting and which approach we would be using, either control or the equity. Now the next step is to go into further details. Further details means we select our operational boundaries. Operational boundaries means that we identify sources within the organization. We identify which GHG emissions we want to report. Now the standard gives three types of GHG emissions which an organization should report. One is direct GHG emissions, other is energy indirect GHG emissions, and third is other indirect GHG emissions. Now, many a times you would also see many companies refer to GHG protocol. GHG protocol and ISO 14064 are same. First came the GHG protocol. From the GHG protocol, this standard was derived. Both both give same requirements. Only thing is the different terminology. The direct GHG emissions, which are referred in ISO 14064, these are called scope 1 emissions in the GHG protocol. The energy indirect GHG emissions in ISO 14064, these are called scope 2 emissions. And other indirect GHG emissions, These are called scope 3 emissions. Now, what do we understand by direct GHG emissions? Direct GHG emissions, these are from sources that are either owned or controlled by the company. In other words, a boiler within a company, boiler is owned by the company, the coal that is used in the boiler that results in GHG CO2 emissions. So those will be direct GHG emissions. Energy indirect GHG emissions, these are the emissions from purchased electricity. The electricity which a company is purchasing from grid, because that electricity is coming from some power plant. So that power plant would be consuming coal. So whatever electricity we consume within the factory, those come under energy indirect GHG emissions. It also refers to imported electricity or imported steam or imported heat. Other indirect GHG emissions, these are the emissions that are happening because of the company, but these are from sources which are neither owned or controlled by the company. I'm sorry for this transition of slides. There is some transition set up in that. So every time you switch on this, you shift to the next slide, it goes to the next slide. So I'm just turning it back. Sorry for that. So other indirect GHG emissions, these are uh, emissions which are happening because of the company, but these are from the sources which are not owned or controlled by the company. In other words, transportation of raw material, transportation of finished product, any outsourced manufacturing, paper consumption, employee travel, business commuting. So these are the other indirect GHG emissions which are also called scope 3 emissions. So as per the standard, the scope 1, scope 2 are mandatory to be reported. Scope 3 is optional. Scope 3 they have kept optional is because many a times the data is not available, or whatever data is available, that data is not sufficient to calculate GHG emissions. For example, a company has the payment records for the payment made to the supplier. Now on the payment records, we cannot calculate GHG emissions. We need either the fuel consumption or the kilometers traveled. So it has been observed that many a times uh, the data for scope 3 emission is not available. So the main scope 3 emissions which many companies are reporting are mainly employee commuting. Employee in commuting, they can take data from respective employees. They can have a form, ask the employees to fill out that form. Business travel, the travel desk in the company would be having the business travel data. Then paper consumption, that companies are normally having. Transportation of raw material and transportation of finished product, because that data they can take from the contractors or the company to whom they have assigned that job of transportation. So these are the 5-6 different types of scope 3 emissions which are commonly reported by many companies. And other than these emissions, the data availability is a big issue. So this is a diagrammatic representation of how a company will start reporting their emissions. See, we have a parent company. So this company has A, B, C, D companies under it. So this is the organization boundary. And then within the organization boundary, there are different sources. So for example, company A has shift fleet, company B has some power generation unit. So these will become the operational boundaries. And then out of these, uh, for example, a power generation unit will be a direct GHG emissions. Car fleet will become other indirect. So we first of all we select the companies for which we want to report, and then subsequently within the companies we select various sources and type of emissions. We'll just briefly also look at the what are the risks, and opportunities for GHG emissions. See, one of the biggest risks is regulatory risk. See, India has set up INDCs, so uh, you never know whether uh, you know in the future some kind of legal requirement may come in. Right now we have only PAT and REC, so but these are energy related. So from the GHG point of view, uh, India has INDC set. So recently, our Ministry of Environment, Forest and Climate Change, so they have got that PMR fund sanctioned from World Bank. So PMR is Partnership for Market Readiness. So World Bank through PMR project is funding various countries to develop voluntary carbon market. So our ministry has already got the fund sanctioned. So you never know, in future some kind of voluntary carbon market may come up. So companies, if the voluntary carbon market comes up, companies are being asked, you reduce by 10%, and companies don't have the inventory with them. So those companies will be at a big risk. See, they can be supply chain cost and reliability, because ultimately the suppliers, they will pass on their high, emission costs to the customers. Especially, and they can be, product and technology risk, especially, in European countries and outside countries. There's a decreased demand for products which are emitting high GHGs, and there's an increased demand for, competitor products with lower emissions, especially, European companies who have to declare their GHG emissions. For them, buying a product which emits less, which will result in their, less scope 3 emissions. Because if I am a European company and I buy a product which is emitting less GHGs, so my scope 3 will come down. So if I have to report to authorities my total GHG emissions, my total GHG emission will come down. So definitely, studies have shown that especially in developed countries market, there is a increased demand for products which are less GHG emissions. See, again, there can be lawsuits, and most important is reputation. See, consumer nowadays, prefer, products, and prefer companies who are working on climate change, what they call responsible business. Although this thing is yet to come in full form in India, still, in India, for the consumers, the cost is a big criteria. But world over, there are numerous examples. For example, the plastic water bottle industry. See, that they were under big criticism in US. So ultimately, these plastic water bottle industries, they became carbon neutral, and then they increased their reputation that we are a carbon neutral company. So reputation plays a big role. See, if you look at the opportunities, definitely GHG emission reduction results in cost savings. If you want to reduce your GHG emissions, you will look for innovative ways, so it will drive innovation, customer loyalty, improve stakeholder relations. See, nowadays, even some of the investors are also looking at climate change risk, because climate change is now becoming a very big risk, especially, companies which are laying transmission lines. If a hurricane, comes up, cyclone comes up, all the transmission network gets damaged. I mean, the floods in Jammu Kashmir a couple of years back, the damage was almost 10 to 15,000 crores. So now climate change is now seen as a big risk. So companies who are working on climate change, those companies definitely, they will have better stakeholder relations. Now, how do we calculate GHG emissions? So these GHG emissions, the standard gives 5 steps. First, we identify sources. Then we select the methodology. Then we collect the data. We select the emission factors, and we calculate GHG emissions. So in subsequent slides, I'll go over the methodology. See, one of the commonly used methodologies is that, suppose you have fuel consumption in your industry. So you know the amount of fuel that is consumed, and the emission factor that is used. So we multiply the fuel consumed by emission factor. In many cases, suppose the emission factor is not available, or you don't have a country specific emission factor, then the formula that is used most commonly is that we use a carbon content value. We have the fuel oil used, for example, naphtha is there, the quantity of naphtha used. We multiply by carbon content, we multiply by oxidation factor, and we multiply by 44 by 12. Why this 44 by 12 is used? Because 12 gram of carbon results in 44 grams of CO2. So once you multiply the quantity of fuel into carbon content, we arrive at the amount of carbon in the fuel. Oxidation factor, we conservatively take it as 1. And when we multiply by 44 by 12, we get the tons of CO2. So if you don't find any emission factor, You can use the carbon content value. Carbon content would be there in the specifications, or you can do the laboratory test. Second is emission from vehicles. Emission from vehicles, if you know the kilometer traveled, you can use the CPCB emission factors. CPCB had sponsored a study to ARAI Pune, Automotive Research uh, Institute. So ARI Pune, under the source apportionment studies, they had determined those emission factors, and these are specific to Indian driving cycle. So you will find IPCC emission factors also and emission factors on various other sources, but those would not be based on Indian driving cycle. So ARAI had uh, developed these emission factors, uh, using chassis dynamometer test, in which they had, taken the vehicle on Indian roads. So based on Indian driving cycle, they had developed the emission factors. So these should be used. And if you don't have a emission factor for the type of vehicle that you're using, then again you can use the carbon content equation. For example, the diesel consumed in liters, you multiply by density, you multiply by carbon content, and then 44 by 12. Emission to electricity is very simple. Our central electricity authority, they give emission factor databases. So these are based on Indian grid. So we know the total amount of megawatt hour consumed. We multiply by the emission factor and get the tons of CO2. Now we'll switch on to carbon neutrality. See, carbon neutrality, the standard applicable is PAS 2060. Now this standard, it's a PAS stand for publicly available standard. So PAS 2060 2014 is the latest version. Now PAS is applicable to activities, products, services, buildings, projects, towns, cities, events. So nowadays even the events, they become carbon neutral. See, in CII this year, we have a flagship event, Sustainability Summit, and also we have CII ITC Awards. So this year, both these events, we are making them carbon neutral. So this is the first time we are also making our two main events as carbon neutral events. So we would be calculating the GHG emission associated with these events, and then we will be purchasing offsets to make it carbon neutral. But carbon neutrality as such, it can be applied to products, services, buildings, projects, towns, cities. You have carbon neutral cities nowadays. And it's not a very new concept, carbon neutrality. Many companies, Reduce Bank and several other, especially financial sector companies, they have been carbon neutral for the last 10 years. In India, we have several companies that have become carbon neutral. Woodland stores in Delhi, they are carbon neutral. Cycle Band Agavati is carbon neutral. And many corporates, they are in the process of becoming carbon neutral. Now, what are the steps of becoming carbon neutral? As per the standard, in the first step, we determine a subject. Subject means what we want to make it carbon neutral. For example, either the organization or a building or a specific part of the process. What we want to make it carbon neutral. We calculate the carbon footprint, do the GHG emission inventory. Then we develop an action plan. How to reduce GHG emissions. Because if a company has money, they can simply purchase those offsets in the market. Suppose I am a company and I am emitting 1 lakh tons of CO2. So 1 ton of CO2 is 1 carbon credit. So nowadays the carbon market is anyway very down. So the carbon credits which were earlier 3-4 euros, now it is 10-12 cents. So I can easily purchase 1 lakh carbon credits and declare myself as carbon neutral. So if a company has money, they can just spend the money and become carbon neutral. But standard says that this you can do only in the first year. But subsequent years, you have to take some actions. It's not that just by spending money, you declare as a carbon neutral. So you have to have a carbon action plan and you make a declaration that, okay, 3 years down the line, I'll become carbon neutral. See, some companies, for example, they have, targets that I will reduce my GHG emissions by 40% in the next 3 years. So they will prepare action plan. You see, energy cost, GHG emission, these are all related. So any energy efficiency measures you take in your company, those will reduce GHG emissions. So companies will, develop action plan. And see, the point here is that many companies are doing a lot of work on energy. See, many companies, world over, especially in Indian context, they are doing a lot of energy efficiency measures. See, energy audits many companies have done. So when they implement energy audit recommendations, so they reduce energy consumption, they save costs. But many companies just stop at that. But what the companies don't realize is that they are actually, reducing energy, they are saving costs. At the same time, they are reducing GHGs also. So many companies, they are reducing energy, they are saving costs, but they are not reporting the reduction in GHG emissions. So our suggestion would be that if you are reducing energy consumption, you are reducing specific energy consumption, you are reducing costs, that might as well as convert into, GHG emission reductions also. So that will help in your further branding, improve your reputation. So company, they'll determine a target date, they will make an action plan, they will reduce GHG emissions, and then they will calculate the balance GHG emissions that are remaining, which they cannot reduce. Because there are, technical limitations to which, you can reduce your energy consumption. For example, a boiler efficiency cannot be increased more than 84%. So company will have some residual GHG emissions which they would anyway emit, and they cannot go beyond a point. So whatever actions that you take, you reduce GHG emissions, and whatever balance is remaining, for balance you have to purchase offsets or you put up some renewable energy projects. So we will look at some of the scenarios how companies can purchase offsets or develop offsets. See, purchasing is the simplest option. Because you spend money and you purchase the offsets. I mean, you first reduce GHG emissions and whatever residual that's remaining, for that to nullify that, you purchase the offsets. For example, I'm having 50,000 tons of CO2 from my industry. So by energy efficiency and various measures, I reduce 20,000 tons of CO2. So beyond that, I cannot go because either it is economically not feasible or the technology doesn't permit me. So the balance 30,000 tons of CO2 I am still emitting. So now how do I become carbon neutral? That for those 30,000 tons of CO2, I purchase 30,000 carbon credits. So 20,000 tons I have reduced, and the 30,000 which I could not reduce, for that I have purchased carbon credits. So I am net zero emissions. In other words, I am carbon neutral. Now purchasing carbon credits is very simple. See, there are several scenarios, for becoming carbon neutral. The first scenario is purchasing carbon credits. That is, we purchase carbon credits from the market. The most commonly used carbon credits are VCS. That's a verified carbon standard. So because the carbon market is very down, one carbon credit is 10 cents, 12 cents. So, we purchase carbon credits for the residual GHG emissions and become carbon neutral. But the negative aspect is that carbon neutrality is not something that we do one time. Carbon neutrality we have to demonstrate every year, because every year our factories operating, our CO plants, cement plants are operating, our steel plants are operating. So every year the steel plant is emitting so many tons of CO2. So which means that every year you have to become carbon neutral, or in other words, we have to maintain the carbon neutrality status. So if we use scenario 1, that is purchasing carbon credits, then we will have to purchase carbon credits every year. So there are no benefits that we are getting from, other than the becoming carbon neutral, because we are just spending money. That's why, there are other scenarios which are more relevant. Scenario 2 is we install solar PV plants. Nowadays, many companies are putting up rooftop solar. So rooftop solar also has some limitations. that, depending on the roof area available. So whatever electricity that they are consuming from grid, that they can reduce by putting up a rooftop solar, or they can nowadays put up a solar plant outside their premises. Open access is allowed in many states, so that power from the solar plant can be wheeled to the uh, you know to the industry. So they will save costs also. And solar plant lifetime is 25 years, which means for 25 years they would be reducing those GHG emissions. In other words, that they don't have to purchase carbon credits every year. They put up a solar plant, then for next 25 years they have those carbon credits available with them from the solar plant. Similarly, company can put up windmills also. But now the negative aspect of windmill is that the government had accident depreciation benefits, which are the fiscal incentives by government of India. So those AD benefits, they have been reduced from 80% to 40% for windmills. Scenario 4 is a combination of solar and windmills. So many companies who go for open access, they get RPO obligations. RPO obligations are renewable purchase obligations, which means that company has to, purchase uh, those REC certificates, and then that's a renewable energy certificates. So, and then they are given a ratio under the RPO obligation that this much percentage from wind, this much percentage from solar. So, if a company puts up a combination of solar and windmill, then they can use that to fulfill their RPO obligations also, and at the same time, the carbon credits generated from the solar and windmill, those can be uh, used to become carbon neutral. And nowadays there are different models are available. There's a capex model, opex model. Capex model is that we put up the capital cost for solar and windmill. Opex model is we don't put up the capital cost. Capital is done by someone else. We just take the electricity for them. But if we go for OPEX model, then we have to make sure that the other company which is generating power from solar is not claiming those carbon credits. So there should be no double counting. It should not happen that they also claim carbon credits and we also claim carbon credits. Only one person can claim. So you can have an agreement with the other company that along with the electricity, the right of carbon credits also lies with us. Scenario 5 is the most preferred scenario. It is the least cost scenario, and this scenario 5 is being used by companies world over to become carbon neutral. In this scenario, the company sources renewable power through open access. So what happens is, uh, suppose I am owner of an IT company. So now, in an IT company, 90% of my GHG emissions are from electricity consumption, because the servers and data centers and other computer laptop they'll consume electricity. So 90% of my GHG emissions are from electricity consumption. Now many states have allowed open access, so that power we can take from some renewable source through open access. And once we take renewable power, our GHG emissions for purchased electricity become zero. So 90% of my GHG emissions I have reduced to zero. And open access nowadays is cheaper than conventional source of power. See, many companies they have actually reduced the electricity bill by sourcing renewable power. So 90% GHG emissions I have already reduced to zero. For the balance 10%, I can put up some small solar plant or a one windmill. So scenario 5 is the cheapest option. It saves costs also, and it helps you to become carbon neutral. Scenario 6 is tree plantation. See, many companies, they go for tree plantation. In CI, we have a biodiversity initiative. So companies, who go for tree plantation, they should also take into consideration that uh, tree planting should not be the motto. The motto should be, ecosystem restoration. So that's what we also advise companies that, when you go for tree plantation, you go for planting of local species. Because when you are, uprooting a tree, it's not only the tree that you are uprooting, the entire ecosystem associated with that tree, it get disturbed. So when you, do tree plantation, your aim should be ecosystem restoration. Anyway, that is a separate topic of biodiversity. So we do not go into details of the topic, but the point here is tree plantation can also be one of the, you know, scenarios for becoming carbon neutral. The only issue here is, you know, a tree takes almost 8 to 10 years to achieve sufficient girth. There are survival factor issues and there are no revenues. See, another important aspect is scenario 2, 3, 4, and 5, they'll give you revenues also. See, if you put up a solar plant, you sell electricity to the grid. So you will get some, revenues by selling electricity to the grid. Plus, you will get carbon credits. And if you wheel that power, if you don't sell it to grid, if you wheel that power to your plant, then you will save on your ST tariff. So scenario 2, 3, 4, they will give some revenues also, plus they will give you carbon credits, so which you can use to become carbon neutral. So what are the benefits? Uh, Benefits are definitely a new competitive edge. And see, one of the benefits, which the actual benefit I would like to inform is, uh, see, Tata Steel UK, they develop a, steel envelope confidence. So they have this steel envelope which they prepare for construction industry. So this steel envelope, is carbon neutral. So every time this envelope is, is prepared, so they calculate GHG emissions and they purchase carbon credits and make that product carbon neutral. So this information is there on the carbon, in public domain on the, carbon neutral company website. So the Tata Steel UK had tied up with carbon neutral company. So what they have realized is that sale of this envelope actually has increased after they have become carbon neutral because the companies in Europe who are purchasing this product, so they are purchasing a carbon neutral product. So they are purchasing a product with zero scope 3 emissions. So when that, customer uh, is calculating their GHG emissions, so and they are purchasing this Tata Steel product, so their emission actually reduce as compared to the competitor's product. So, and these companies in Europe, they have to report to authorities on the GHG emissions. So their GHG emissions, actually reduce. So the sale of this product has increased because of it being carbon neutral. Because the customers who are purchasing this product, they are purchasing a product with zero scope 3 emissions. So that's a actual example of the benefits of becoming carbon neutral. Definitely, there are energy cost savings also. There are environmental social outcomes. See, when you purchase carbon credits, so most of these projects, for example, it's a biomass-based cogeneration project, or it's a, you know, uh, various other, energy efficiency or other projects. So they also result in some social well-being, economic well-being, environmental well-being. For example, Kutch was a barren land. Now the price of land in Kutch has increased because so many windmills have come in there. So the local community also benefits, from these offset projects, especially people who are supplying their products to European market. So European customers, they would ask those companies to declare their GHG emissions, in the supply chain because those are their scope 3 emissions. So organizations who are already quantifying the GHG emissions, they will have better market access. So this was regarding carbon neutrality. So we will now just briefly, look at the two new initiatives that are there in the market. One is carbon pricing. So CI, we are also partners to Carbon Pricing Leadership Coalition. So this Carbon Pricing Leadership Coalition, this was launched in COP21. It's a voluntary partnership of national, subnational, government, businesses, civil society that mainly work towards strengthening carbon pricing policies and enhance cooperation to share information, expertise, lesson learned. See, they have 4 working groups. So in different working groups, they have a different agenda. One working group is on governance. One working group is on sharing knowledge. Working group is on mobilizing business support. So they work with various working groups, and it's managed by IFC and World Bank. So their main aim is to promote the carbon pricing among governments, among businesses. So we are also partners to Carbon Pricing Leadership Coalition. And if you look at carbon pricing, so there are essentially three types of carbon pricing which are there. See, first is the shadow carbon price. In the shadow carbon price, when we are making an investment, so we also consider a hypothetical or a assumed cost of carbon emissions. Suppose I want to put up a steel plant, so I will see what will be my GHG emission because of the steel plant. So I will try to assume a cost of uh, that GHG emissions that will be happening because of steel plant. So that cost I will add to the overall cost, and then I will calculate my return on investment. So this is a shadow price which is being used. It's very relevant and it's very important for companies to do this because companies uh, actually need to do responsible business. The second type of carbon pricing is internal taxes or fees or trading systems. In this approach, a company will put some tax or fees based on the GHG emission. Suppose I'm emitting, 2 lakh tons of CO2, so I'll put up say $2 per ton of CO2 or some tax I'll put up, and that money I'll have to spend on uh, towards mitigating GHGs or putting up renewables or so it's kind of tax that I'm imposing based on my GHG emissions. The third type of carbon pricing is the implicit price. See, in the implicit price, the companies do not establish a explicit carbon price, but calculate the implicit cost per ton of CO2 based on how much the company spends to reduce GHG emissions. See, one of the very good example is Mahindra Group. So Mahindra Group has set up the implicit price uh, of $10 per ton of CO2. So they have very ambitious, targets. They want to reduce their GHG emissions by 25% in the next 3 years. And they are one of the first companies in India. They are also part of Carbon Pricing Leadership Coalition, and they have set up the carbon pricing. So they are taking excellent measures to reduce GHG emissions. So in the implicit price, the companies they will calculate the how much cost they are incurring on reducing GHGs. For example, uh, company has some action plans on reducing GHGs. So how much cost would be there for implementing the action plans, and that cost they will calculate per ton of CO2. So that will be a carbon price. See, this implicit price is not a price as such. It's like a implicit cost per ton of CO2, but still carbon pricing is a relatively new field. See, in pure economic sense, the implicit price is not a price, but it's a cost. But since carbon pricing is a relatively new concept, and the CPLC and other organizations, they want to promote corporates to adopt carbon pricing. So, uh, that's why they have included implicit price also. So for the details of carbon pricing, you can refer to Carbon Pricing Leadership Coalition website, or you can write to us. We can share more details. So we are also now working to promote this carbon pricing among Indian companies. So another, important recent development which we would like to share is there are recommendations on task force on climate related financial disclosures. See, there is a financial stability board. So this is an international body that monitors and makes recommendations about the global financial system. So this financial stability board, they had established a task force on climate related financial disclosures to give recommendations so that the companies can also declare their climate related disclosures along with the financial reporting. In other words, companies who do the financial reporting, along with this financial reporting, they can also, declare what are their climate-related disclosures and what are the financial impacts of that. So they have given mainly four, recommendations. What they say is that along with the financial reporting, a company should also disclose what is their governance structure. Governance structure regarding climate-related risk and opportunities. What is the company's strategy? What are the impacts of climate related risk and opportunities on the organization, business strategy, financial planning? Because nowadays companies, they have to consider climate change as a risk. See, companies who are in coastal areas, companies who are say thermal power plants who are dependent upon water, and suppose there is water scarcity because of climate change. See, companies, nowadays they have to, inbuild all these things into the risk management process, because natural resource, is, there's a, is on decline. See, there is a, global footprint network which has, shown that right now we need, 1.6 times Earth. We need 1.6 Earth to sustain our human beings. See, there is a concept of, Earth overshoot day. So this Earth overshoot day means that uh, the date by which we consume all the resources which our Earth can regenerate in a year. So this Earth overshoot day last year in 2016 was on 6th August, which means that till 6th August we had consumed all the resources that, our Earth, Mother Nature could, replenish in a year. So that means from 6th August to 31st December, we had put a lot of burden on the Earth. So that is why the companies, nowadays they have to include all these things. See, there are so many instances, of companies shutting down because of water not available, or companies have to get water through tankers. So companies have to consider climate change as a part of the risk management. So what is the company's strategy? They have to disclose. Uh, they have to disclose how the company, identifies and manages climate change risk, and what are the targets and metrics, the parameters they measure. So these are recommendations of Task Force on Climate Related Financial Disclosures. So under when the company do financial disclosures, so this also Carbon Pricing Leadership Coalition is promoting in India. So many Indian corporates also are member of this task force. So so this is one of the latest new development that has happened. So this is really aimed towards telling corporates that along with your financial reporting, you also report on how to uh, consider climate change risk and opportunities, because sooner or later companies will have to realize that climate change is a big risk, and they have to consider that, because many of the companies you will find they have a separate risk management team. They have a separate, when it comes to say sustainability reporting, they have a separate risk committee. But why have two different risks? See, one is for sustainability reporting, one is for your at the corporate level. Even the new 2015 version of ISO 14001, it also says that environment should be part of the corporate strategy. So essentially, the at the corporate level, the risk assessment that is being done, uh, those should also include environment, climate change as part of the risk assessment. So that is now becoming the focus world over. So I think with this, we'll stop here. There is actually already the time is 4 o'clock. So because there is so much of material on these topics, so we would so that's why we had spent 15 minutes more. So just for information, our center does a lot of consulting in training, inventory, neutrality, reporting. We do training in 1464. So we have your emails. We'll keep you posted on the trainings. We have a training on GHG inventory in August first week in Chennai. So we'll keep you posted. So now we'll start the question answer session. So we thank you for your time. So we would request if you could just type in your questions in the question box. So we'll reply, one by one. So we have first question uh, from Mr. Ravi Chandra, which is the best method to report? See, best method to report. I mean, if I understand, is regarding that control or equity approach. So that depends upon the company's policy. Which I mean, there is no best method. It depends upon that particular. There is from company to company. If a company has a lot of equity in various other countries, so equity would be best for them. But if there's a corporate office, it has around 20 manufacturing units in India, for which it is having financial operational control. So for them, control would be a better option. So companies, most of the companies, they normally use control option, because they report GHG emissions for those companies for which they have financial or operational control. So then your next question, Mr. Ravichandra, is that what about industries? Whether PAS 2060 is applicable? See, PAS 2060 is applicable for industry. It can be used for industries also. It's a standard which can be used for events, every product services industries also. Industry also PAS 2060 is applicable. Then your next question was, is there any certified provider for selling offsets? Definitely, there are registries are there. There are three registries in VCS. There's a market registry. They have office in Noida. So you need to, just take the membership of the registry. There's, I think, $500 is the fees, one-time joining. So once you become member of registry, so all those people who have the certified offsets. Certified offset means that offsets which have been verified by some validation verification bodies such as Bureau Veritas, RINA, URS. So there are several certification companies in India who validate and verify these carbon offsets. And those offsets will be there in the registry. So you can either go to the registry, become member, and purchase offsets, or you can have a one-to-one, direct buying from the seller also. Uh, but that seller also would transfer those credits through some registry only, because ultimately all these carbon credits are there in. See, for example, CDM will be there in the unit triple C registry, VCS will be there in the market registry. So ultimately, you will have to become member of some registry by paying a nominal fees of $500. So once you become member of the industry, of the registry, then you can buy offsets. So next question was, from where carbon credits are purchased. These are purchased from registries. You have to become member of registry and purchase carbon credits. In India, market registry is there. Uh, in fact, in India, we have so many people, because there are so many, CDM projects people had put up, and now there are no buyers. So that's why, uh, the price of carbon credits has come drastically down from 3-4 euros to 10 cents, 12 cents. So you'll get these carbon credits very cheap. Yeah, so you need to just, you go to the VCS website. It's a verified carbon standard website, and from there will be a link to the registries. So there is a market registry, then there's the APX registry. So market registry is also, they have an office in India and Noida. In Delhi, they have an office. So but you don't need to go to the office. You just need to, become a member of the registry. There's online, to the website. You just fill up that form online and, pay the fees. So once you are, member of the registry, you will get all the details of various people, various, suppliers of carbon credits. All those people who have put up, solar plant, windmills, and they have these verified carbon credits. So all those details along with verification reports would be there, on their registry. So you can purchase from the registry. Hi Sandeep, your question is, nowadays hotels are doing carbon neutrality for them. How to calculate emissions from food waste? Is there a guideline? Definitely, food waste also, there are emission factors. Ultimately, it depends upon what is the fate of the food waste. If it goes to landfill, or if it goes to landfill, then the methane emissions are there. So there are emission factors which are there based on methane emissions from landfills. And so, and also to mention, there is also a India GHG program. See, the India GHG program, program is there from WRI, CII, and TERI. These three organizations, we have launched this India GHG program. So in that India GHG program, you can search on the Google, and in the website, you will find several emission factors which are India specific. For example, train emission factors. They have developed a railway emission factor for India. So, you will find emission factors which are specific to Indian conditions from their website. Regarding food waste, Sandeep, there are emission factors which are there. So I can send you the emission factors, See, next question from Mr. Neeraj Agarwal. Can you please share the slide showing on GHG emission for India and China? Sure. The entire webinar, is recorded, and we'll send you the link, in next few days, where you can see the entire recording. Then Mr. Pratik Shrivastava, he has asked how to report emissions from vehicles moving inside plant premises. Do we report it in CDP? See, See, for the vehicles which are moving inside the plant, so if you have the kilometers traveled, then you can use CPC emission factors. But normally for vehicles which are moving inside the plant, you will have the amount of fuel that is consumed in those vehicles. So, because normally the diesels are issued by the factory industry only. So these, the amount of diesel that is used in those vehicles, from that you can calculate those, you know, GHG emissions. The next question from Mr. Patuli Shivashankar is that, do you feel implicit costs are better than shadow or the explicit carbon cost? See, normally, if you look at it, the shadow price is like a very is the carbon price in true sense. So a company actually selects which is the best investment based on the overall return considering the carbon cost. So it's kind of a very strict measure. Many companies are using implicit cost. uh, in other words, the costs which they use to reduce GHG emissions. So implicit for a beginner or for a starter of a company, who you know are starting for the first time, definitely implicit cost would be better, because it'll reduce the financial burden of the company. Because if you start rejecting your investments based on shadow pricing, then it's like a management decision which the company has to take, that whether they actually reject an investment because of very high shadow price, or because the resource is a big issue in many companies. The you know uh, Although there are dedicated sustainability teams, but then the companies, especially the CFOs, they decide as to how much financial resources are available for mitigating GHGs, how much company can afford, the techno-economic feasibility they select. So implicit costs are being used by most of the companies, especially Indian companies, because they are actually spending money on reducing GHG emissions, and they are using to show implicit carbon price. So implicit costs are better for companies which are starting the carbon pricing, because uh, in pure economic sense this is not a carbon price, it's only a cost. But still companies are the CPLC and other organizations, they are promoting this because just to promote various corporates. So my suggestion would be that in the beginning implicit cost would be better, and once the company has enough resources, I mean they have that enough financial resources available, so then they can go for other carbon pricing also. See, next question from Patule Shankar is that, what is the scope of life cycle assessment in the industry in India? Definitely, nowadays all these new ISO standard, for example, the ISO 14001 2015 version also, they ask to look at the life cycle assessment. Although they don't specify to do a life cycle assessment, but they say you think from a life cycle perspective. So, especially for in India, many companies are doing life cycle assessment, but they are doing it for mainly for products. So the scope is there, but it's not, if you say, as great as is there in other, developed world. But definitely, companies are looking at life cycle. There are ISO standards also 14040. So, my suggestion would be that, there is scope, but uh, it's there is mainly in large corporates. See, most of the initiatives that you would see is mainly from large corporates. They are doing a lot of voluntary initiatives, and they're doing life cycle assessments. They are looking at they're becoming zero waste to landfills. So many of the large corporates, they are taking a lot of voluntary initiatives, because there is no mandatory requirement to do life cycle assessment. Even the new 2015 version says that you think from life cycle perspective, but they don't actually say that you do a life cycle assessment. So most of the initiatives are, you would see in the large corporates, because they have, because and these large corporates also, they are competing in the international market. See, most of the Indian MNCs, they are there in 100 countries, 140 countries. So their competitors in the international market has already gone way ahead. So it's kind of the market forces that actually govern such kind of studies. So I would say the scope of life cycle assessment is more in Indian MNCs who are competing globally. See, one full grown tree, Mr. Rajesh Singh has asked. So, see, one full grown tree neutralizes almost 0.39 tons of CO2 per year. Although if you can write to me, I can send you further details and all the calculations also. See, then question from Mr. Ravi Chandra is that whether CIITC is planning to buy credits from VCS or CDM, year triple C. See, normally CDM we cannot buy because CDM is for developed world. So we probably will buy from VCS because we have these two events, the our sustainability summit and our CIITC awards. So we want to make them carbon neutral this year. So for making them carbon neutral, we will be calculating the entire GHG emissions coming from these two events, and then we would be buying VCS credits because see, we are not a manufacturing industry where we can do some other initiatives. So only option left for us is to buy credits. So for these two events, we would be buying VCS credits. Thanks a lot, Mr. Ravi Chandra. Thanks for your comment. Um, Next question from Mr. Patul Shankar is that why would anyone invest in carbon credits now that they are essentially useless? Shouldn't we shift to a more legally binding system? See, Mr. Shivashankar, our ministry has already got the PMR, fund sanctioned. PMR is Partnership of Market Readiness. So this PMR project is mainly aimed towards developing voluntary carbon markets. So it is expected that by 2020 we may have a carbon market. So people are not investing in carbon credits now. Only those companies are investing where they want to use those carbon credits internally for becoming carbon neutral. So companies, those who are investing right now, they are not investing for the purpose of selling, but they are investing for the purpose of using them to become carbon neutral. The question of Engineer Neeraj Agrawal is that should carbon pricing and perform achieve trade benefit be considered at the same time? See, actually, PAT is PAT benefit in the PAT benefits you reduce your specific energy consumption, so you also reduce GHGs. So, see, you can claim that you are reducing so much GHGs, but then carbon pricing is a slightly different concept. Carbon pricing is essentially how much money you are spending per ton of CO2 to reduce GHGs. So, in the PAT, you will get how many tons you have reduced, but then if you use an implicit price, then you would calculate that how much money I have spent per ton of GHG reduction. So, in PAT, you can claim GHG reduction benefits. When in pricing, you need to declare how much money you have spent. Patulesh Venkar, thank you for a comment. It's my pleasure to answer the questions. Mr. Ravichandra, thanks a lot. So I think uh, we have now done with this webinar. So I thank all the participants for sparing their valuable time for attending the webinar. So in any case, if you have any further questions, you please feel free to write to us. See, we will circulate you know the entire the recording of this webinar. Mr. Neeraj Agarwal has asked, what if we consider shadow pressing? Definitely, shadow pressing is but it's like a carbon pricing in true sense. But then when the companies when they evaluate different options, so if they consider shadow pricing, then they will have to consider the carbon cost associated with a hypothetical carbon price, and then they calculate the return on investment in considering carbon cost. So then they will have to choose that particular project or a particular option which has the best return on investment considering shadow pricing. So I mean it's a good thing to do, but then the company has to also consider their other aspects also, whether they have so much of resources available, whether they are in a position to you know, reject an option which may be cheaper, but maybe having higher emissions. I mean, it's a good thing to do this, but only thing is the company has to also see the the market conditions, their financial resources available. If companies are positioned to consider shadow pricing, then it's an excellent thing, you know. But many companies nowadays are looking at implicit price because because one of the main reason is that it's a relatively new field. Many companies are not aware also. So that's why in the CPLC Carbon Pricing Leadership Coalition, they are having various webinars uh, and various other uh, you know forums in which they go and make presentations. They want to they interact with the industry. So they are basically promoting this carbon pricing. They are sharing knowledge. Every month the CPLC has a webinar in which the industries which have already implemented carbon pricing, they share their experience. So that's a good, information for the other companies who want to, you know, implement, carbon pricing. So, so I think we'll close here and now. So we thanks a lot to everyone for sparing a valuable time. So it was very nice interacting with you. If anytime if you have any future questions, you please feel free to write to us. So CI, we are also industry body only. So we are a membership-based organization. So we work for the industry. So for us, any time you have any questions or any doubts, you can please feel free to write to us. We'll also keep you posted for our upcoming trainings. Anyway, thanks a lot. Have a nice day. Bye.